Hey everybody, and welcome to this week's edition of the Answer Desk. I'm Bill, your host, and with me today is Benjamin Stark, certified financial planner with Vision Retirement. Hey Ben.
How you doing, Bill?
Doing well, and you?
Great.
Great, thanks for joining us today. Let's go ahead and answer a question.
Sounds good.
That's been submitted to us this week. I'll pull one out, and let's see what it says. So this week's question, I'm in the process of buying a home. Is it worth buying down the interest rate?
So is it worth buying down the interest rate?
Yeah, how does that work, Ben?
Buying down the interest rate is also known as buying points, and 1 point is typically 1 percentage point on the loan. And there's a number of factors that go into play, whether you want to maybe sacrifice some liquidity up front because you're paying those higher fees, trading off a lower monthly mortgage payment and alleviating cash flow throughout the life of the
Is a mortgage point different than like origination points?
It is, Bill. So an origination point actually comes from the underlying fees of generating the mortgage. These fees typically can't be avoided because the mortgage company has to pay an underwriter to actually create the loan. So oftentimes these fees are bundled in, and then optionally you're given the choice to buy the mortgage points once the loan has been generated.
So how do I determine or figure out whether buying points or buying down the rate is worth it for me?
I think everyone's circumstance is a little bit unique in that factor, because some folks are perfectly comfortable with, again, because you're paying more money up front, it gets added into your initial down payment. So if you're already maybe doing a down payment of 20 or 25%, maybe this might not make sense for you, but for someone who's maybe considering something a little bit less, maybe 5 or 10%, and now all of a sudden they have a higher mortgage payment, but they have additional savings, they might say, you know what, maybe I'll put down 12 or 13%, add some of those points, and then that'll help alleviate some of that cash flow.
And then how do you determine sort of break-even point of how long do I have to stay in a house to sort of break even? Is there a formula or?
Yeah, it's pretty simple, and I'll just give a basic example. So if you buy 1.1% on a $100,000 mortgage is $1,000, and it saves you $10 a month, let's say, in your monthly mortgage payment. You add those two numbers and you get 100. So 100 is the number of months that you would need to be in the home paying the mortgage before you break even. So just under 10 years, roughly.
Can I just call you and figure this out so you can figure it out for me?
Absolutely, that's what we're here for.
Speaking of points, did you know that I once scored 16 points in the fourth quarter of a championship game?
You know, you always like to tell me this and you never let me forget it.
All right, on a serious note, thank you very much, everybody. And thanks, Ben, for joining us this week. And we'll see you next week.
Thanks, Bill.